fixed income market, the Fed has turned a little more dovish of late and opened the door for rate cuts, which has led to a considerable decline in yields to 210 about on the 10-year yield. In Europe, the move has been similar, with bond yields nearly at all-time low, expecting the ECB to remain dovish. In this context, the search for yield has been a key driver of European sovereign bonds, and we've seen a lot of flows, especially from Japan, including in southern markets like Spain and Portugal. We've seen new interest coming in these sovereign markets. In credit, it's been spreads have been widening a bit. We see some value in there, and we think it's valuable to stay exposed to credit for the months to come. The markets had a very tough month in May. World indices lost about 6%, anywhere between 4% in Europe and the US, and 7% as concerns Japan. The escalation of the trade war has been a considerable negative impact on equity markets, feeding some selling. The attacks on specific Chinese companies by the Trump administration will spark retaliation, and that will continue to feed some volatility and selling in equities. In this context, earnings revisions are coming down, and therefore valuations are not improving as much as they had in the past. So we're not ready to jump in. However, in Europe, we see some value in the defensive sector, and also in the growth themes that is valuable in terms of providing relative performance in this context. In sum, the trade war escalated, and that weighed considerably on investor sentiment. However, we think that the Fed has lots of room now to cut rates and help to stabilize market in the coming months.